Hello, beautiful people. Welcome to another brand new episode of the ITU Forex class. In this week's episode, we're actually going to be talking about three things that are very, very important in trading, which a lot of inexperienced traders and struggling intermediate traders tend to struggle with a lot because understanding these things is very crucial to your profitability in trading. Okay, so the first of the three, or let me quickly just give you a brief rundown of the things we're going to be talking about, which is the spread, swaps, and slippage. Okay, so we're going to be talking about spreads, swap, and slippage. Now, these three things I just mentioned, they're actually the costs you incur, or at least the first two, they're the costs you incur in normal day-to-day trading activities. Okay, because when you're trading the market, you're obviously going to be doing that, the spot forex market that is, you're obviously going to be doing that through a forex broker. Okay, so that forex broker is actually providing you a service where he is acting like the intermediary between you and the spot forex market. Okay, so assuming this is an a-book broker simply means a broker who, when you place a trade, he actually places that trade on your behalf in the pool of trades in the main market, the spot market. Okay, but there are B-book brokers, which are brokers who are actually going to take the other side of your trading position. So, for example, when you place a buy trade, the broker, if that is a B-book broker, he's actually going to be selling that instrument to you, and so he's taking the opposite side of your trading position. And most of the times, the problem with B-book brokers is that there's a conflict of interest, because when you make money, they lose money, and when they lose money, because they're taking the other side of your trading position, you are obviously going to make money. And so most of the times, because of this conflict of interest, B-book brokers tend to be sketchy, tend to be unethical most of the times. And that's one of the reasons why when you're looking for a broker to trade with, you want as much as possible to find a broker who is going to be an A-book broker, who is going to pass your orders directly to the market. Okay, and I know some of you might be thinking, okay, why in the world will a broker take the other side of his client's trading position? And the answer is pretty simple. When you look at the stats of the trading industry, you just see how much of a good business that is for them. So what do I mean? If you have been in the industry for a long time, you've probably come across the stats where you'd hear traders saying that 90 up to 95% of traders who trade the spot forex market lose money in the long run. Okay, and so this particular stat, brokers tend to see it firsthand because they have access to your back end. When traders are placing those trades, they are doing that through a brokerage firm, and more often than not, brokers see the amount of money that traders lose to the market by doing that. And so it's just good business on their part for them to take the opposite side of their client's trading position, because over 90% of the clients that are going to be trading with them are usually going to lose that money. And so if they were to pass the trades to the liquidity provider, obviously they would be doing the service which they are recommended to do. But if they don't do that, and they often take the opposite side of the trading position of their clients, when the client loses that money, they are the ones who are going to be banking that money. And so it's good business for them. Okay, the 90% losing majority of traders lose money, and so the broker actually makes that money that the clients lose. And that's the simple reason why brokers, especially B-book brokers, take the opposite side of their trading position, because if they know 90% of their clients are going to lose money, I mean, it's a no-brainer to just take the opposite side of their client's position. And so they just, the measly 10 or 5% of traders who are going to make money, they are just going to take from the money that those clients who lost are going to lose, and just pay out or give the profits to those lucky few that are going to be profitable. Okay, now that aside, in a normal ideal world, okay, the service that forex brokers render to their clients in a normal world, where we are assuming this is an ideal world where brokers are not acting in in their own best interest and against the interest or wishes of their own clients. In a normal world, those brokers are usually going to charge their traders by three things. The first is spread. So, what is spread? Spread is simply the difference between the bid and the ask price of a trading instrument. Okay? So, for example, if the bid price of the Euro USD was 1.1852 as it is now, and its ask price is 1.18522, the spread, as you can see here, is going to be 2 points. And that's one of the reasons why immediately you place a trading position, you're going to see that you're in the negative. The reason is because when you place a trade, you're going to immediately you place that trade, you're going to be affected by the spreads. The spread is usually the cost that you pay for that spread is usually how brokers tend to charge their clients for the service they offer those clients, which is in this case serving as an intermediary between the client and the spot forex market. Okay, so they are taking your orders, and in an ideal world, like I told you, they are not doing any B-book shady thing. They are taking those orders that you're placing and they are passing it through to the live markets. Okay, but that's not the only way that brokers charge their traders, okay, for the service they provide for them. Some brokers charge spreads alone and they don't charge commission. Now, when brokers charge you spreads alone, most of the times, because they want to be compensated for the services that they are offering you, most of the times, if they are not going to charge you any commissions and it's only going to be spreads, you would notice that with such brokers, their spreads are going to be very wide. Wide in the sense that instead of just charging you a couple of points, okay, 10 points make one pip, obviously. So instead of just charging you a couple of points, some brokers might charge you pips, not even 1 pip or 2 pips, depending on the instrument you're trading. So if you're trading the major instruments, remember we talked about this, the major and the exotic instruments, and major currency pairs, exotic currency pairs, and the minors and all of that. If you're trading the majors, obviously, because they are part of the most traded currency pairs in the world, their spreads are going to be very tight. But if you're trading the exotic pairs or the minor pairs, their spreads are usually going to be wide. Now, it is not uncommon for brokers who are charging you spreads along with commissions to make it in such a way that the spreads that they're going to be charging you are going to be very tight. Okay? Now, with this particular example that I'm showing you, you can see that the spread for this is only 1 point, and sometimes you might even see that it goes down to 0. This is because this particular prop firm in this example, they are offering you their service, and they are not only charging you spreads, they are charging you commissions as well. And because of that, they can afford to give you, very good pricing or very good costs, whatever the case might be. And this is where you would hear some traders telling you that they like trading with brokers who offer raw spreads accounts. This is because raw spreads accounts, obviously, or more often than not, are going to give you very, very tight spreads. In fact, with raw spreads accounts or zero spread accounts, it's not uncommon for you to see brokers offering you no spreads whatsoever. It's going to be 0. And then all they are going to charge you is commission for the particular position you're trading. Some traders, some brokers, depending on the currency pair you're trading, they'll charge you something like, let's say $5 per lot, per standard lot of the instrument you're trading. So if you're trading like one standard lot of the Euro USD currency pair, they might just charge you $5 per round term. Okay, so when you get into the market with the trading position, they might charge you, $2.5, and if it's $5, when you're closing the position out, they will charge you another $2.5, and that's how they make their money. So these are A-book brokers, and in an ideal world, these brokers are, when you place the trade, they will just take that the trade that you placed and channel it to the live markets. And they're not taking the opposite side of your trading position. And so because of that, there's no conflict of interest between you and that particular broker. And this is one of the reasons why you really need to do your due diligence when you're opening an account with a brokerage firm. The reason is because if you open an account with a brokerage firm which is acting as a B-book broker, because there's this conflict of interest, meaning when you place a trade, they're taking the opposite side of your trading position. And so when you make money, they lose money. And when they lose money, you make money. When you trade with that type of broker, it is in the broker's best interest for him to give you all sorts of bad trading conditions so that you'd lose that money and you'd make the money that you lose. And so you need to be very, very careful. This is part of the things that traders don't know because they are busy looking for the holy grail trading strategy to trade. Let me tell you something. You could have the holy grail trading strategy, but if you're not careful and if you don't factor in the cost of live trading, then you might cost of live trading, obviously, by spreads, swaps, commissions, and the other things we're going to slippage and the things we're going to be talking about as we progress through this class. You might have a profitable trading strategy, but because of the cost of the trades that you're placing, then you might obviously not even be able to make anything at the end of the day. And so you need to trade with a broker who is going to act in your own best interest. You can see that now the spread has gone down to 0 for this pairs, okay? And this is because this broker doesn't mind, obviously it's a prop firm, but the conditions are, because these are the major pairs, are very good. And so you get, very, very tight spreads with commissions along the way, okay? So again, let's do a quick recap before we move on to the next thing we're going to be talking about, which is swaps. Spreads are the difference between your bid and ask price for the instrument you're trading. And this is the way that brokers in an ideal world charge you for the service that they are rendering to you. And this is one of the reasons why immediately you place a trading position, because of this spread, you're going to see immediately you place the position, you're in the negative. And so if you were to close the position immediately, the broker is going to take, that slight difference is how he's going to make his money. And if price was to move against the spread and into profit, you're still going to pay that broker. Whatever happens, whether you win a trade or you lose a trade, that trade that you place, the broker is going to charge you and he's going to make his money. Point blank, period. Okay, so moving on. The second thing we're going to be talking about is swaps. And this is one of the things that a lot of traders don't really understand how it works until they get hit by huge swap costs because they don't understand how it works. So let me give you a quick rundown of what swaps are and how they affect you as a trader. So swap is the interest rate differential which is charged by your broker for holding trades open overnight. This is a mouthful, I know, but when I explain it to you in a layman's term, you're going to understand exactly what we're talking about here, okay? So if you were to borrow some money from a bank, okay, assuming it's not an Islamic bank, it's a secular bank, okay, you're obviously going to, for that money that you borrow, you're going to pay interest along with the principal that you borrowed from the bank, okay, depending on the term and agreements you arranged with them. Okay, so you're not only going to pay what you borrowed, but you're going to pay them interest along with what you borrowed. Now, in the forex markets, because you're dealing with the live interbank market, the biggest market in the world, when you trade a currency pair, you're basically buying one currency against another currency. You're selling one currency and buying one currency. And so, since this is the interbank market, where you're dealing with this large pool of multinationals and big financial institutions, usually for you to hold a trade overnight, you would have to pay interest for the currency pair you are owning or you're buying, and then you would earn interest on the currency pair you bought, for example. So the difference between the interest you're paying for the instrument you bought or you sold and the instrument you bought is going to be the interest rate differential. And that is what swaps are. Okay, so let me quickly show you an example in action. Okay, when you right click on the charts on your market watch window in MetaTrader, you're going to see a lot of instruments. Okay, so we're going to use this particular Euro USD instrument as an example. So when you right click on it in the market watch window, you could do this for any currency pair, by the way. Okay, click on specification. Now this is going to show you a lot more details about the instrument you're trading here with this particular broker. So if you have MT4 installed on your charts and you do the same thing, it's going to show you the instrument for your particular broker that you're trading with. Okay, so in this case, you can see that this is showing us the information about this instrument. It's showing us that it belongs to the currency sector because it's a currency pair. Okay, if you were to check something like gold, I'm pretty sure you're going to get something different. So in this case, let's right click on gold, XAU USD, and right click on, you can see that the sector it belongs to is commodities. Okay, so going back to forex currencies, okay, specification, right click on specification. Now you can see that in the number of digits that it has, it's actually denominated in 5 digits. So we have it's down to the pipette. Okay, so it's showing you that, and the contract size is 100,000 euros. So when you're buying or selling one standard lot of the euro USD currency pair, you're actually transacting 100,000 units of the base currency in the currency pair, which in this case is the euro. Now the spread is not fixed spreads. Some brokers offer you a fixed spreads. For example, if it's fixed, for example, and it's 1 pip or 2 pips or 3 pips, whatever change price does in the market or whatever volatility spikes in the market, that spread is going to be fixed at 3 pips. But if for this particular example is floating, this means it's variable. It's going to keep changing. And you can see that earlier on I showed you it went down to 0, it came back down to 1, now it's at 0. You see it was 2 just a couple of seconds ago, now it's at 1. So this is floating because it keeps changing. The spreads is not fixed. Okay, now moving on, you can see that the margin currency is euro. Profit currency, that's when you make a profit or a loss on the trade, is in USD because the account is denominated in USD. These are all informations about the currency pair. But what I want to draw your attention to is this thing right here, these two. We have swap long and swap short. What this simply means is that if you're trading one standard lot of the euro USD currency pair, for example, if you're going long, if you hold an open position on the euro USD overnight and it goes overnight, okay, you are going to pay $12.07 for holding that position open if you're trading one standard lot of the pair. That's in addition to whether the loss that you have on the pair or the profits that you have. If your account is not an Islamic account, it's a standard forex trading account, you are going to have to pay this amount, which is $12.70. Okay, and a lot of traders who are beginners don't know this. They might just, start trading and they find a trading strategy that they like. Maybe it's a swing trading strategy. Obviously, if it's a swing trading strategy, you're going to be holding trades overnight a lot, because swing trading by definition is where you are going to open your trading position and it's going to last more than one trading session or one trading day. Okay, and so effectively you're going to hold trades for many days at a time. And so if you're going to be swing trading, it's very important for you to understand how spreads, how swaps are going to affect your trading position. So if you were long on this currency pair, you're going to be paying $12.70 for every single day you hold that position open. And if you went short on the currency pair, again in this case, you're going to be paying $3.40 for holding that trading position, one standard lot of that trading position overnight. And if you were to trade more than one standard lot, let's say you're trading something like 10 standard lots, then just the swap alone is going to cost you, if you're long on this currency pair, for example, if you're trading 10 standard lots, just the swap alone is going to cost you around $127 every single day you hold that trading position open. And so you see how it adds up, And if you don't factor all these key things into your trading, then you're going to have a very difficult time, or you're going to have a rude awakening when you get hit by all sorts of fees, okay, swap charges and your spreads and your commissions and all of this, without even you making money on the trade. Or it's going to compound on your losing trades. So for example, you might have done your proper risk management calculation, and let's say you are risking 1% of your trading account capital on every trade you take. Okay, you've done the calculation. But then, because you didn't factor the effects of swaps on your trading position, and you hold that trading position overnight because you're using a swing trading strategy for a couple of days, then you might end up risking much more than that 1% if you hold that trade for a long time, for days at a time. And then eventually, if you don't factor in swaps and commissions and all of this, you might end up losing much more than 1% that you set out to lose. So you need to understand all of these things and try to work around them. If you don't want to pay swaps and you want to hold trades overnight because you're trading with a swing trading strategy, for example, then you can opt for Islamic account, a swap-free account. That's what they are called. Okay? So the first way that brokers charge you, like I told you, for the services they provide to you is by charging you spreads and commissions. The second way is when you hold trades overnight, and that's through swaps. So they're going to charge you swaps overnight. There are instruments where you're going to, instead of your swap long and your swap short being negative, one might be positive and one might be negative. And so effectively, you might get, the interest rate differential might be positive, but again, it's not worth it. For me personally, I trade with Islamic accounts, and so I don't worry about paying swaps. But if you want to learn more about it, you can Google a couple of videos or check it out on YouTube and learn more about it. Okay, we're just kind of like scratching the surface here so that you understand that these costs actually exist and how to work your way around them. Okay, so the third thing we're going to be talking about is slippage. So how many of you have heard about slippage? Just let me know in the comment section. How many of you have traded the markets or traded on a demo account or just had an interaction with the markets and you've heard about slippage? Before we get your answers, or obviously you could read through the answers of others, slippage is actually kind of like when you get a bad feel in the market. So what do I mean by a bad feel? So for example, let's say you wanted to get into the market and sell this currency pair somewhere around here. Let's say, depending on your analysis, you spotted maybe an order block or whatever the case might be. However, you choose to identify your trading opportunities, long, short, or whatever the case might be. And so when you spotted this opportunity, you decided you wanted to short this currency pair at this particular price, for example. Now, slippage is when you get filled at a worse price than the price you said you wanted to get in at. So, for example, let me quickly show you an example here, okay? Let's say you wanted to short this currency pair in and around this price level, which when I use my crosshair, you'd see that is around the 1.17767 price level. But then, because there's, let's say, right when you were about to enter into the market with the trading position, the market got hit with a big news report. And all of a sudden, there's a spike in volatility in the market. Because of this, the spreads are going to widen significantly because of this, okay? And when this happens, instead of you getting your sell trading position or your short trading position that you clicked on at the price that you wanted to get in at, you might get filled at a much worse price than the price you wanted to get in at because of this slippage. This is what is meant by slippage. So you wanted to enter into the market with your trading position at a particular price, but because there was high volatility in the market because of some, economic reports or news release or geopolitical event or whatever the case might be, you got filled at a much worse price. Because if you had gotten filled at the price you wanted to get in, then when price moves just a little bit, you're going to be in profit. But when you get slipped, usually you're going to get in, you wanted to get in here, but then you got in somewhere around here, and now price needs to go all the way below that bad fill that you got for you to even make a tiny fraction of profits. And so, out of all of the things that we talked about today, the first two or three, because we said swaps, we talked about spreads, commissions, that's how brokers actually charge you, for the service they render to you. And then swaps, obviously, because you're dealing with the interbank market, you're going to be charged or paid swaps if you're not trading with an Islamic account. This is not actually a charge that a credible broker is going to charge you when we're talking about slippage. Slippage is the result of high volatility in the market. Okay, and so it's not as if when you have slippage is the broker's way of charging you so that they will make money. Obviously, if it's not a big broker, that's not the case. Slippage just happens when there's a surge in volatility in the market. And so because of that, because of the geopolitical or economic events that cause that slippage to happen, you're going to get filled at a much worse price than the price you wanted to get filled at. And that's because of, obviously, if there's nothing shady going on, that's because of high spike in volatility and all of that. Okay, so these are the key things that you need to know and pay attention to. when you trade with a broker, when you're about to trade with a broker, it is advisable, and this is one of the reasons why most traders don't even know. When we teach them and say, okay, you should find a trading strategy that fits your personality, and then test that trading strategy in a simulated trading environment, and then before going live, find a broker who is ethical, and then place trades through that broker on a demo account to test his platform, to test their platform. Obviously, part of the reason why we tell you to do this is not just because, you know, we just want to make you go through a lot of stress or tedious work before you start trading. Part of the reason is because you want to see how these brokers charges are computed or how they will affect your trading. So you want to see how their spreads are. Is it variable? Is it fixed? Is it high? Is it very tight? Is it wide? You also want to see how much their commissions are, how they charge you for their commissions. You want to see how often you get slipped or slippage affecting the trades that you place. That's part of the reason why you want to do demo. Because in the demo stage, when you're trading with a broker and you notice that it's as if that broker is not an A-book broker, he's a B-book broker, obviously you're going to have a conflict of interest between you and the broker. And so he's going to be giving you bad fills and slippage and extra cost and all of those things that will just make it almost impossible for you to make money. When you do that and you find that out on a demo account, then you've just saved yourself a lot of money. And so you're going to go and trade with a broker who is going to be in line with your goals. And so you're going to work together with that broker without any conflict of interest. But if you don't do all of this, you're going to find out the hard way by losing your hard-earned money to a broker who is unethical, a shady broker, a bucket shop broker, or whatever the case might be. Okay, and so this pretty much brings us to the end of this week's edition of the class. And as usual, before we wrap up the class, I'd like to use this opportunity to invite you guys to test out our trading robots, which are designed to trade on your behalf and get you earning while you're learning how to trade. They're going to find low risk probability trading opportunities on your behalf. Place those trades. If you follow our risk recommendations, they will place those trades for you with proper risk management and get you earning while you're learning before you know what. Okay, so if you're interested, please reach out to us on any of our social handles or drop a comment in the comment section letting us know that you're interested, and we'll be more than happy to assist you and walk you through how to set everything up step by step and get you up and running as fast as possible. And this pretty much brings us to the end of this week's edition of the class. But before we wrap up, a quick recap. Again, spreads are how brokers charge you for the service they provide for you. And spreads are usually the difference between your bid price and the ask price for the instrument you're trading. Okay? Some brokers don't charge you spreads. They give you zero spreads. That's the tightest you can get, but they charge you commissions. And this type of brokers, they're ideal for traders who are scalpers, for example, because when you're scalping, you're just in and out of the market aiming for very small pips. You just want to make maybe 1 or 2 pips and you're out of the market. When you find a broker that is charging you zero spreads, that is going to be best for scalpers, because scalpers can afford to, they prefer to pay commissions than get bad spreads, because as soon as they enter into the market, if it's zero spreads, if price just moves just a point in their favor and they're trading with, proper risk management, they're going to make a profit from that, and they'll more than pay for that commission, without any stress. But swing traders, on the other hand, most of the time, swing traders are not too worried about paying a little bit of spreads, because their positions obviously they're aiming for hundreds of pips at a time, or much more than that, okay? Or day traders, for example. The next one is, we talked about swaps. This is the interest rate differential that you pay or you get paid by a broker for owning or holding a trading position open overnight. And then the last one is slippage. Any broker that just keeps giving you slippage for every trade you place or whatever, that's a bad look. And so you don't want to trade with that broker, because obviously there's something shady going around. If it's not news time and there's no high volatility in the market, but your broker just keeps slipping you at a very bad price, then that broker is not having his interest aligned with yours. So it will be much better for you to find a reputable broker who is going to be booking your trading positions and not taking the other sides of your trade. And so with all that said, I thank you very much for taking time out of your busy schedules to come to this class and being as engaging and interactive as you have always been. And I look forward to seeing you guys in next week's edition of the class. I sincerely appreciate your support and your enthusiasm in learning and trying to improve as a professional trader, getting profitable day by day. So I look forward to seeing you guys in next week's edition of the class. And once again, God bless you all. Have a wonderful rest of your week and go out there and crush the markets, okay? Go out there and change your financial status by applying what you learn in the markets, okay? Thank you, and I look forward to seeing you guys in next week's edition.